start tonight with that strong US jobs report. And the reason is it has investors now worried that the Fed will soon raise interest rates rather than cut them as they had hoped. The Dow Jones and the S&P, as you saw just a moment ago, both closed well into red, but the tech-heavy Nasdaq, that bore the brunt, losing 4%. This morning's US jobs report showed that the economy added a robust 172,000 jobs. That's about 70,000 more than expected. Now, the strong number could give the Fed room to raise rates this year because in the balance of its dual mandate between inflation and full employment, it would seem inflation is now the more serious issue. President Trump complained about the market reaction. He says the jobs report should have instead sent stocks higher. Chip stocks were particularly badly hit. The Philadelphia Semiconductor Index, which tracks the sector, plunged more than 10%. Just look, all the major players were sharply lower. And the weak guidance from Broadcom that we told you about earlier this week really has given question to the whole chip rally. Paul LaMonica joins me. Guru LaMonica, we're going to get into the economics in just a moment. I want to focus with yourself. The market doesn't like what it's seeing, but what is it that they don't like?
Yeah, I think, Richard, that the market is clearly nervous about whether or not all of these investments in AI are going to pan out. Obviously, you mentioned Broadcom's earnings and the resulting slide in that stock, and chip stocks broadly have tumbled as a result. There's a new memory chip ETF, relatively new ETF with the ticker of DRAM. It was down 15% today. You know, Micron is a big holding in that, as well as the South Korean giants SK Hynix and Samsung. But take a step back, Richard. What I'm heartened by, and I'm going to be in the uncomfortable position of actually being somewhat bullish and maybe, dare I say, Pollyannish. If you look at the S&P 500 today, about 243 stocks, nearly half the stocks in the index, were actually higher. Utility stocks were higher. Real estate stocks were higher. Consumer staple stocks, healthcare stocks. Yes, this was a headline number for the broad market that was ugly. But many stocks did go up today. It was tech that really got crushed.
I guess the fear, and we talk about it on this program almost nightly, is that at some point when future earnings can't justify these very high valuations, you really have only one option, and that is the price goes down. And that's what we will start to see. Now, that could feed into a much wider and more brutal market reaction.
Exactly. If earnings growth starts to decelerate rapidly, that is obviously problematic. But first quarter results were phenomenal. And if you look at estimates for the second quarter, analysts are still projecting more than 20% growth in the S&P 500. I agree. It bears watching whether or not this AI-induced slowdown hurts the broader economy, but we're not seeing it in the estimates yet. I think another concern, as you obviously alluded to with the solid jobs report, the Fed isn't going to be cutting rates anytime soon. Rate hikes could be back on the table potentially later this year, even though Kevin Warsh is perceived as being more dovish than his predecessor, Jerome Powell.
How long do you think they've got before, the canary is singing so loudly that you can't ignore it and you have to move?
It's not going to be at the next meeting, which will be, Warsh's first in a few weeks. We do have CPI and PPI numbers coming out next week. That will give another sign of inflation. But also, this is going to be interesting to hear from Warsh and others on the Fed. Inflation, we all know, is something that usually causes the Fed to raise rates. But this is an unusual bout of inflation. It's commodity-led, oil-led because of the war in Iran. That ultimately could lead to weakening demand. And if that's the case, the Fed wouldn't want to necessarily raise rates and further hurt consumer demand. I'm not saying they should cut rates, but maybe they hold steady until the war is over.
That is the conundrum that they face. With a commodity-led bout of inflation, how do you manage that? I'm grateful. Thank you, Paul and Monica, joining me.